Welcome back, everybody. Today is Tuesday, June 24th, 2025. Today's episode begins with our headline, Consumer Confidence Falls and Stocks Rise. It was forecasted that the consumer confidence would rise from 98.4 to 99.4 when it actually dropped to 93. In a nutshell, the report said that the labor market is essentially solid, but the expectations of three parts of this index, business conditions, employment prospects, and future income, all weakened. Consumers were more pessimistic about business conditions and job availability over the next 6 months, and optimism about future income prospects eroded slightly. Report after report, things are not looking good. Yet all Mr. Market seems to care about is what's going on in Iran, which allowed stocks to rise, and leading into our second headline, junk bond credit spreads tightening. HYG, a junk bond fund, broke above a previous top trend line that we had going on. And when you strip out the overall yields, take out the treasury yields to see the difference between junk bond spreads and treasuries, this also went up quite a bit today. It's when you divide HYG over SHI, you can take a look at this. And I just want to point out a little trend line here that I noticed that's kind of frightening. Just to sort of show you what typically happens when credit spreads get too tight. So if you look at this blue line up here, from all the way back to 2013, when you have HYG divided by SHI, you can make the chart yourself on TradingView. When we were at that level in 2013, we had a pretty good crack to the downside. We hit it again May of 2014, which led us into a major spreading of credit between junk bonds and treasuries. And then we get there again in 2019, right before the COVID crash. We bump our heads on it on 2021 before the not recession of 2022. And then we've been bumping our heads on it very recently in December, and then again in January before the April crack to the downside. And we're hitting it again right now. If this is any indication as far as charts go, to perhaps credit spreads may be widening pretty strongly in the very near future. This gave me confidence to purchase more HYG puts today, which can benefit when credit spreads widen, which I expect to happen. I had ChatGPT illustrate the way that I feel about what's going on here. It includes everything in my macro views on my website. On this side, the giant wrecking ball weighing this is a scale weighing between uninverting yield curve. There are some mistakes. This was done by AI. Not going to lie. A housing bubble market bubble, consumer sentiment at record lows, rate cut cycle, jobless claims rising. And then on the other side, we have junk bond spreads, 3%. And, this is the way the scale is working right now. We have a feather over here, and we have a wrecking ball over here. This is the way that I see what's going on. Anywho, moving on to the community topics, channel updates, suggestions, likes, dislikes. Obviously, you may have noticed some changes in the daily show for today. I don't know which ones I might go back to tomorrow or just leave it as it is or continue to evolve. I'm really curious. I want to ask the community specifically, do you guys have any suggestions for the show? Any specific things that I do that you particularly like, that you particularly dislike? Ideas to help improve the show. I'm all ears since I do the show for you guys. I'd love to know, get some feedback from you if you want to leave any in the comments. And then moving on to the coming up section, we have coming up Thursday GDP second revision. It was negative 0.2%. We'll see if it gets revised lower. That could actually really rock things. Jobless claims could also rock things if we start really it seems like everybody I listen to is expecting this thing to really get out of control sooner than later. But we'll see what happens on Thursday. Friday, we have PCE inflation data coming out. We also have, by the way, the tariff updates. Did we all forget about the tariffs, Mr. Market? Yeah, Iran. Yeah, well, the tariff thing is still a thing. I don't know how long it's going to take for Mr. Market to wake up to this fact, but I'm certain that he will once we start not worrying so much about the geopolitical stuff, I suppose. We also have to look forward to federal budget updates and, like I said, the Iran-Israel conflict. As always, thank you for watching, subscribing, commenting, and supporting. I think I'm 26 subscribers away from 1,000. Thank you for all your support. See my website to read through my daily reminders and macro views. No changes to the crystal ball readings nor the Robschild portfolio, except adding to the put contracts on HYG. Moving on to charts, SPX S&P 500 gapping higher, 1.1% today. Some people are expecting to at least get to a double top. In other words, just hit the same high that we were at before some people will be like, oh, I don't know if we can go higher. But who knows? Mr. Market will always do very surprising things. The VIX fear gauge no longer elevated in my book, 17.5. And the VVIX confirms we're in a healthy zone, suggesting stocks can keep going up right now. TLT, my favorite place to be, rose 0.73% today, engulfing yesterday's entire candle with its almost with its wicks. Anyhow, we are still inside this forever blue channel. I'm gonna say again, this typically is a bear flag and will typically break to the downside, even though TLT is still my favorite place to be. If we end up in a situation where stocks just keep going higher and higher, I'll see that as an opportunity to sell into strength and actually increase my exposure to long duration treasury bonds. Again, like I mentioned yesterday, one thing supporting TLT to continue moving to the upside is the 10-year treasury note yield, which is something that is more important than the longer yields. It's more important than TLT. It's a more powerful market, and this yield is looking just straight out bearish. We had this head and shoulders top, and we closed today actually at the bottom of the wick of yesterday. So my favorite trader, Gareth Soloway, always says you have to close below the wick. I don't know what he would say. It closed to the penny. I think it was 4.29. Yeah, it was the exact low of yesterday, and that was exact close today at the low. Fascinating. But anyhow, this, in my book, again, I never claimed to be the greatest chartist in the world, but the 10-note treasury yield to me appears to be very bearish. So this suggests perhaps we could be going into a correlated state where TLT and stocks are correlated together, and sometimes they're uncorrelated, where stocks go down, TLT goes up, and the opposite. We could be in a correlated state in that way. I am also noticed, very interestingly, DXY, the dollar index, once again hit this previous line that I drew a while ago. Just 1, 2, 3. We touched it today. Will the dollar break to the downside or not? Next up, crude oil. After worrying about oil shocks, now it seems that the expectation is de-escalation and that things are ending. I think the crude oil market wants a little more confirmation before we get back down into this ultra low zone below $65 a barrel. We'll see how it pans out. With stocks going up so much, I was really curious to see if the put to call ratio would be rising here. Options have been getting less bearish. Sorry, not less bearish, more bearish. We'll see if that continues or if people are going to start loading into more calls. Scrolling out, you can see there aren't a lot of put contracts being bought and sold right now overall. Just something to keep an eye on. Last chart of the day, I haven't brought this up in a little while, the 10-year break-even inflation rate. The larger structure, we are still in a lower low, lower high, lower low, lower high situation. It was Thursday, June 12th, when I saw this collapsing to the downside. I was wondering if this was going to just fall off a cliff. Instead, we rebounded. We got to a peak of 2.33, and then yesterday and today dropping again, going sideways more than anything. Biggest point here is that we are still structurally in a lower expectations of the inflation rate, from this chart. It's trending lower over a longer period. And also, with Waller recently coming out and other Fed members saying, hey, maybe we should cut in July, like, we're starting to see some weakness in the labor market. Of course, you have to have some people. I bet I wouldn't be surprised if Powell himself told these guys, hey, we need some of you to act like you are on, the side of more dovish. But with the break-even inflation rate not yet getting back down to 2%, I think this is what controls the Fed's decisions more than anything. I also think that they're expecting this by August to be back down around 2%. But as it stands right now, while we only have a week and a half left before the next meeting, sorry, I take that back. The next meeting is July 30th. So we have over a month. So, with Powell acting more hawkish right now, things could definitely change by the time we get there. So before I go, sorry for the errors today and every day for all of my nonsense. I'd love to hear your comments in the comments below. Any suggestions, things that you particularly like, things I used to do that I don't do anymore that you wish I did, or things that I've been doing that you just straight up don't like or think need altering or changing. No wrong answers here on Robschild. I just like hearing from you guys any feedback that you might want to give me. And one more last thank you for watching, subscribing, commenting, and supporting. That's all for today's show, and I'll see you next time. Robschild.